attention, notice it because obviously it might be quite an interesting outcome. So this was the big spread that came in, and this is an unusual spread because it's going from the twos to the ultras. Now that means it's basically almost an outright trade, right? This is almost the equivalent of an outright. And when you see this, it's 39,000 2 years against 7,500 ultra bonds. You see that? They bought the 2 year and they sold the ultra bond, which means they are short selling treasuries. You agree with that? If you buy the 2 and you sell the ultra bond, you're short selling treasuries. Now, how do we know that? Because obviously all we do is we look to see whether this is a positive or a negative correlation to bond prices. So when you look at it against bond prices, you'll be able to recognize that this is almost a perfect negative correlation, as you would imagine it would be. So when you do that spread, what they're basically doing is they're short selling treasuries. So when that trade came in here at 1502, which is 902 Chicago time, then of course that meant that they were starting to short sell treasuries at this price. Well, if you were looking for that trade, of course, you got a great opportunity to then tap it back into the top edges, a trade that we did take. I think I shouted it live in the room as well. I says, look, we're looking at selling above the 16s. Did anybody hear me saying that? We showed the curve. We were hoping the curve would improve for the short sell to come in. And then all of a sudden, somebody did 39,000 2 years and 7,500 ultra bonds. Now, that's a big spread, right? That's a pretty meaty size spread, especially on the very, very back end of the curve going all the way out to the ultras. This is almost an exact negative correlation. This is almost an outright trade. It is not really a curve trade. This is not really a curve trade, guys, is it? I mean, you can't argue that this is curve. This really isn't curve. This is almost outright. And because of that reason, I'm going to treat it as an outright play. So when I get into the top edge retest at 17s, I want to start selling my treasuries. So it traded 17s, it traded 18s, it tapped the 19s, tapped the 20s even. So you're obviously starting to work that short sell off the 19s and the 18s. Currently trading 12s. Does anybody see it? Anybody pay attention to it? You should be paying attention to these things, guys. They are, if you've ever wanted to know real-time institutional trading, it's on your screens. It's right there. There it is. It's real-time institutional trading. These aren't all the trades, of course. These are only the trades that are done off-screen. That's what block trades are. They're trades that you will not see on your trading view charts. These are trades that will be done off-screen through the block trade agreements. And then they're advised to the exchange once the trade is completed. They then get advised to the exchange. So this trade was obviously off screen, bank to bank, and obviously that was the deal. Buy the 2 year, sell the ultra bond, and that means that we're basically looking at the short sell on the ultra bond, simply because you can then look at the relationship and say, well, that long spread is, of course, short bonds. I should be selling short bonds if I can get a similar or better price, because that is a fair size, almost outright institutional bank size trade right there. 39,000 front end contracts, 7,500 back end contracts. That is not chump change, guys. That is not chump change. You multiply that 7,500 contracts by $100,000 per contract on the ultra bond, you're getting a fairly substantial amount of money in terms of the back end of the curve here, aren't you? Remember, $100,000 per contract is the value of a futures contract, of course.